Super Microcomputer hit an all-time intraday high of $12.29 per share on March 8, 2024, only to pull back 36% a little over 4 months later, recently closing at $7.83. Despite that, year-to-date, the stock is still up 174%. Is Super Microcomputer going to continue its slide, or is it an AI rocket ready for launch? Let's dive in and find out. All right, quick shout out to your man, Zach, for suggesting this week's company. 3 things that we're going to cover in this video. Number 1, background/business model. Based in Silicon Valley, Super Microcomputer provides high performance and high efficiency server and storage systems for a variety of markets, including enterprise data centers, cloud computing, artificial intelligence, 5G, and edge computing. Part 2, the opportunity, positives, and negatives. While Super Microcomputer is in a very strong competitive position in a niche space, they do face direct competition from Dell, Hewlett-Packard Enterprise, and Cisco, just to name a few. Despite those formidable competitors, Super Microcomputer is going to more than double its revenue from 2023 to 2024, along with expanding margins and increasing profitability. But has the stock gotten ahead of the results? Number 3, valuation. On Wall Street, we build 3-statement financial models culminating in a DCF valuation. I have built a 3-statement model for Super Microcomputer, and I can't wait to give you the results. So let's dive right in. If you're enjoying this, please smash that like button. All right, part 1, background/business model. The company was founded in 1993 by Charles Liang, who started the company with a vision to provide high-performance server technology. The company is headquartered in San Jose, California, which is located right in the heart of Silicon Valley, allowing easy access to tech talent and industry collaborations. The company specializes in high-performance, high-efficiency server technology, which focuses on delivering cutting-edge server solutions that cater to demanding applications like data centers, cloud computing, and enterprise IT. The company IPO'd, initial public offering, in 2007, so they've been around for a while. They have a focus on continuous innovation in server, storage, and networking solutions. They're consistently introducing new products and technologies to stay ahead in the market. And they're also expanding into green computing solutions. They're pioneering energy-efficient technologies to reduce environmental impact and operational costs. Lastly, the business model. How do they make money? So the product segment's 92% of revenues are comprised of server and storage solutions. So for server solutions, that includes rack mount servers, blade servers, GPU servers. They're customizable to meet the specific needs of clients, ranging from small businesses to large enterprises. And then the storage solutions are high-density storage systems designed for data-intensive applications like big data analytics, video surveillance, and archiving. The other 8% of the revenues are based in networking solutions. Now, these are advanced networking hardware, including switches and routers, to ensure fast and reliable data transfer within and between data centers. Now, in terms of the revenue breakdown geographically for 2023, 70% was the United States of America, 20% was Asia, and China's only 1%. Europe, 7%, and other 3%. Now, in terms of how they generate these revenues, there's 3 ways that they do it. 1 is direct sales channels. This is direct engagement with large customers that ensures tailored solutions and long-term relationships. Number 2, channel sales. They leverage a network of resellers, distributors, and system integrators to reach a wider market. And then number 3, services. They provide support, maintenance, and consulting services, which enhances customer satisfaction and loyalty while generating recurring revenue. Okay, part number 2, the opportunity, positives, and negatives. I want to hear the bad news first, so let's roll with the negatives. Okay, the last insider purchase was February 1st, 2024. Since then, there have been $35 million worth of sales at an average price of $868, but a range of $540 all the way to $1010. This is obviously a red flag, negative sign, especially if you think the stock is undervalued. We would anticipate that management and insiders would be buying shares if they thought it was undervalued. Also, intense competition. The company lists Cisco, Hewlett-Packard Enterprise, and Dell as competitors. While they're bigger than Hewlett-Packard Enterprise, Dell is twice the size of Supermicro, and Cisco is 4 times the size of Supermicro. So competitive pricing strategies can impact profit margins, and constant innovation requires significant research and development investment. Also, supply chain risk. We saw this big time during COVID. Dependence on component suppliers, potential for disruptions, relying on a global supply chain for critical components, which can be disrupted by geopolitical tensions or natural disasters. Also, the impact of global semiconductor shortages. Ongoing chip shortages can affect production schedules and delivery times. Regulatory and geopolitical risks. So there's exposures to trade tensions, especially between the US and China. We're obviously in an election year, so we'll see how that plays out. But tariffs and trade restrictions can impact cost structures and market access. Also, compliance with international trade regulations. They have to navigate complex regulatory environments across many different countries. And stock volatility. There's the potential for significant price fluctuations. The stock price can be highly volatile, influenced by broader market conditions and tech sector performance. They're also sensitive to the broader market conditions and the performance of the tech sector. So when you think about it, at the end of the day, as the tech sector becomes more and more volatile, they're going to be negatively impacted. Also, market trends and investor sentiment in the tech sector can significantly impact stock performance. All right, now that we're done with the negatives, let's hit up some positives. So Supermicro computers sold to over 1,000 direct customers in over 100 countries in 2023. These customers represent a diverse set of market verticals, including enterprise data centers, cloud computing, AI, 5G, and edge computing. Another positive, no customer represented greater than 10% of the company's total net sales. They are in a strong market position. They're the leader in high-performance server solutions. They're recognized for innovative and reliable products. They also have a competitive edge with customizable and energy-efficient products. They have an ability to tailor solutions to specific customer needs, leading to high customer satisfaction and repeat business. Financial health. They're showing consistent revenue growth and profitability with strong financial performance and steady growth in revenues and profits. We're going to see this next in the valuation. They also have a strong balance sheet with manageable debt levels. This shows a healthy financial position, sufficient cash reserves, and low debt. Okay, innovation and R&D. So the company has continuous investment in R&D. They have a commitment to innovation with significant annual investment in research and development. They're also pioneering green computing and energy efficient technologies. They have a leadership in developing eco-friendly computing solutions. And lastly, growth opportunities. There's increasing demand for cloud computing, AI, and big data. The rising need for high-performance computing solutions in these rapidly growing sectors perfectly positions Supermicro. Also, expansion into emerging markets and sectors. There's a potential for significant growth in underpenetrated markets and new industry verticals. All right, this last part's really awesome. Significant partnerships. The company has partnerships with Intel, AMD, NVIDIA, and others. So in terms of their partnership with Intel, they have a long-term partnership with Intel for high-performance processors. They use Intel Xeon processors in many of their servers, and they collaborate on advanced technology like AI and high-performance computing. AMD. For those who don't want Intel, they also offer servers with AMD EPYC processors. These are known for high core counts and energy efficiency, which are ideal for heavy computing tasks. Lastly, NVIDIA. So they use NVIDIA's GPUs in servers for tasks needing a lot of computing power like AI and machine learning. They also provide NVIDIA certified systems for guaranteed compatibility and performance. And they also engage in joint projects. So they work together on new technology like edge computing and AI data analysis. Now, those aren't the only partnerships they have. They also have other key partnerships. For example, with Microsoft, they ensure servers work well with Microsoft software like Windows servers and the Azure Stack. Also, VMware, they offer virtualization solutions compatible with VMware, making IT management easier. Red Hat, they work with Red Hat for open source and container applications. And Broadcom, they integrate Broadcom's networking technology for fast and reliable connectivity. So what are the benefits of these partnerships? Obviously, they're going to create better products. They have access to cutting-edge technology for high performance, innovation. They're staying ahead with new tech developments. Also, this is a significant competitive edge. They're keeping a strong position in the market. And then lastly, and most importantly, customer satisfaction. They're creating reliable and compatible products, leading to happy customers. All right, part three, the moment we've all been waiting for, the valuation. So starting out with the balance sheet, cash has increased 3.7x over the last 5 years. Inventory has increased 70% over the last 5 years. Now, this should make sense because this is a very inventory-intensive business because of the servers. Now, while debt has increased more than 12x over the last 4 years, Supermicro has net cash, which means their cash is greater than their debt, giving them a lot of financial flexibility. Also, retained earnings has increased 2.7x over the last 5 years, mainly due to the increase in net income. We're going to see this next in the income statement. So what's the takeaway? Despite growing rapidly, the company is financing its business with cash and retained earnings rather than debt, resulting in a clean balance sheet, making for a sustainable business. Let's hop in the model. Okay, the balance sheet, as mentioned, we have a 5-year increase in cash of 3.7x, very impressive. Alternatively, we also have an increase in inventories. This isn't a negative. We want to make sure that they have enough inventory on hand for all these servers that they're working on. Now, debt, you see a massive increase in debt, but it's okay because we can see that cash is greater than debt. And then lastly, we see a massive growth in retained earnings. This is a tremendous positive. Next, we have the income statement. While revenues have more than doubled in the last 5 years, 2024 estimated revenue is projected to increase 106 to 112% due to rapid AI-fueled growth. Now, normally we would see some inefficiency here from a cost management perspective, but we do not see that. From gross margin all the way down through net margin, we have seen significant margin expansion across the board. Case in point, over the last 5 years, gross margin has gone from under 13% up to 18% in 2023, while net margin over the last 5 years has gone from 1.4% to 9% in 2023, a relative increase of 6.4x. Now, because of this margin expansion, the company has grown net income, which has significantly increased free cash flow. We're going to see this next in the cash flow statement. Now, as you might expect from the above, profitability has increased substantially, with return on equity going from under 6% to 37.7%, a 6.6x increase over the last 5 years, and return on invested capital going from under 6% to over 30% in 2023, a 5x increase over the last 5 years. Now, I've mentioned this previously. Warren Buffett loves return on invested capital because it takes debt into account, and his personal hurdle rate is 15%. Supermicro Computer is at double that amount. So what's the takeaway? While the company has grown rapidly, it has managed to keep costs under control, resulting in massively increasing profitability. Let's hop in the model. All right, y'all, income statement. So we see, as mentioned, a massive increase in revenues, 2.1x over the last 5 years. But something else to note, 2024, it's supposed to more than double. Crazy. But while we've also seen this massive increase in revenues, look at what's going on with the EBITDA. You've basically seen a 6x increase in EBITDA over that same time frame. And then if we go down all the way to net income, we see a 5-year increase of 13.9x. Always remember, revenue is what you make, net income is what you keep. So this is just showing that the company is super efficient from an operating perspective. One last thing to note, taxes. The company's tax rate is around 15% historically. So I went super conservative here and went with the US marginal corporate tax rate of 21%. Okay, next we have the cash flow statement. So free cash flow has increased 10.5x over the last 5 years, primarily driven by net income. Now, something to note in the projections, we see a significant increase in inventories to support top line growth, but this does result in the company having to draw on a revolver to accomplish this. Now, the main reason is that we have the company maintaining cash as a percentage of revenues of 6% based on their historical numbers. Again, this is very conservative. The company might not need to do this, but just something to keep an eye on. They have scheduled debt repayments of $280 million over the next 5 years, which they can easily cover with cash on hand. Now, to reiterate at the bottom, we see a revolver draw in the first 3 years of the projections with excess cash in the final 2 years. So what's the takeaway? Supermicro Computer is a solid and consistent generator of growing cash flow, but they do need to manage working capital so as to not draw on a revolver in the projected years, which will help maintain financial flexibility moving forward. Let's hop in the model. All right, the cash flow statement. So we see some remarkable stuff here, a 10.5x increase in free cash flow, which we're defining as operating cash flow less CapEx, primarily driven right here by net income. As I mentioned, you see a big outflow as a result of the increase in inventories. Obviously, they need that inventory there so that they can build out these servers. Debt repayment, as mentioned, $280 million. They have more than enough cash to handle that today. And then another last thing to note here, if we look, they're pulling on or drawing on a revolver in the first 3 years, but they generate excess cash in the last 2 years. Again, this is something that we would want to be mindful of on a going forward basis. All right, next we have forecast drivers and DCF assumptions. The company projects $14.7 to $15.1 billion in revenues in 2024. So 14.9, the midpoint, was chosen as the base case, with 27% forward revenue growth. Also, the company has done an outstanding job managing its cost despite rapid growth. For a high-growth AI server company, they have a reasonable beta of 1.3, which is risky but not high risk. Also, I want you to focus on the terminal multiple of 14 times LTM EBITDA, which is below the comps average and is in line with historical levels for the company. So just be mindful, this is also well below the current multiple, which is 38.1 times, but I feel that it's a bit inflated. We're going to see this next in the DCF valuation. So what's the takeaway? Conservative assumptions are going to give us conservative results. Let's hop in the model. Okay, as mentioned, you can see right here, massive ramp up in revenues, more than double in 2024. We have pretty consistent costs decreasing over time as a percentage of revenues, which is a tremendous positive. Okay, moving down to DCF assumptions, we have a 5-year risk-free rate because it's a 5-year model, 4.15. I mentioned the beta of 1.3, market risk premium just below 4%, cost of equity of 9.31. If you look at their post-tax cost of debt, very low. Ultimately, the company has no credit rating, but they do have a very low cost of debt, which they raised during COVID. If we look at the weighted average cost of capital, this is super reasonable, just above 9%. We should get a pretty reasonable valuation as a result of that. Also, a couple things to note, based on their last Q, they have over $2 billion of cash now, and that's compared to $1.8 billion of debt. So they still have about $250 million of net cash based on the most recent financial filings. And then lastly, I do want to touch upon this. This is an incredibly important point. Remember the terminal multiples from the end of the model out into infinity. Right now, the current multiple for Supermicro is 38.1 times. Now, I'm going to pop open this note right here. So if we look at the comps, we get an average of 14.5 times. If we exclude the high and the low, which I like to do, we get 15 times. So we would be perfectly justified using either one of those for the terminal multiple. But if you look at the bottom there, Supermicro over the last 15 quarters has had an average TEV to EBITDA, excluding the high and low, of 14 times. So of those three choices, I'm going to go with the lowest one to get the most conservative valuation. Okay, DCF valuation. We ran 3 scenarios, bear, base, and bull with the current model at base. Remember, we're taking future cash flows, discounting them back to today to get to total enterprise value. We strip out net debt to get to equity value. This company is a leading player in the high efficiency server space with eye-popping growth. They have net cash of $250 million, but with a year-to-date increase of 174%, is it worth buying today? Wall Street has Supermicro at a median of $1,030 per share, which is a 31.5% discount. But what does our analysis show? Let's hop in the model. All right, DCF time. So we have EBITDA, we strip out depreciation, we get EBIT, strip out cash taxes, we get EBIT. Remember, we add back DNA, we take into account changes in operating working capital, strip out the CapEx, we get free cash flow to the firm or unlevered free cash flow. Remember the terminal value, we have it set to 14 times EBITDA. That comes out to about $60 billion. We discount all of these back to today. That leads us to total enterprise value. We strip out the debt, we add the cash, we strip out non-controlling interest, add in associate investments, we get an intrinsic equity value of $41.3 billion. Now, based on their current shares outstanding as of the most recent quarter, we get an implied share price of about $705 compared to the current close of $783. We get a 9.9% premium, which is a sell rating. Now, something I want to mention over here, if we ran it at those higher multiples, 14.5 and 15 times, we still get a sell rating. It's ultimately a difference for each half turn of about $24 in share value, but we see a premium across the board here. Right, next we have sensitivity and scenario analysis. We ran 50 different models by utilizing data tables. We sensitized revenue growth versus CapEx intensity and weighted average cost of capital versus the terminal multiple. Now, what were the findings? 46 out of 50 or 92% showed sell, 4 out of 50 or 8% showed hold, and 0 out of 50 or none showed a buy rating. We ran each of those 3 scenarios equally weighted and got a weighted average value of $716 per share, which is an 8.6% premium. So what's the takeaway? Utilizing conservative assumptions, we show a sell rating for the stock at a slight premium. Let's hop in the model. Okay, sensitivity analysis, we see pretty much across the board, it's a bloodbath. So we end up having a sell rating, 92% of the scenarios. If we look down below, I mentioned the terminal multiple, even at 16 times, we end up getting a hold rating. But long story short, the company's just not trading at a discount right now. So we're not going to make any silly decisions and go into a stock that appears to be overvalued at the current moment. Lastly, we go to the scenario analysis here. We see equally weighted. We get a bear all the way to a bull of not a buy rating. So we have about 520 in the bear, 924 in the bull. But even in the bull case where we have more aggressive assumptions, we get close to a buy rating, but it's still a hold rating. At the weighted average 716, we get a premium of 8.6%. Obviously not going to be a buy. Okay, the wrap up. So Wall Street has Supermicro Computer at a median of $1,030 per share with a high of $1,500, a 92% discount, and a low of $325, which is a 42% premium. Now, $325 to $1,500, you could drive a cruise ship through that. That's a massive, massive gap. The stock is up 174% year to date, while the S&P is up 17% year to date. That means Supermicro Computer has performed 10 times better than the market. That's insane. So this is a stock that was trading at about $280 earlier this year and is now trading close to 800 bucks. You should seek the advice of an investment professional always. I do not have a position in Supermicro Computer, but if it got below 600, it would be on my radar. The company is a leader in the niche space of high efficiency servers, which will be important moving forward as AI continues to grow. With a $519 value or 34% premium in the bear case, all the way to a $924 value and 18% discount in the bull case, Supermicro does not fall into our criteria of a 20% discount for a buy rating. As with most supernormal growth companies, it's very difficult to determine when growth will decline, by how much, and what will be sustainable growth moving forward. With the AI craze, Supermicro Computer has gotten a little ahead of its skis, and while it is a phenomenal company with a leading position in a niche space, we want to buy great companies at a fair price and not overpay. Now, if you like this and want to see another compelling tech stock valuation, check out my PayPal model right here or my SoundHound AI model right here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.